What's going on, guys? Thanks for tuning in. This is Ryan, aka Kenner and Clark with BlockRoots. And as always, please not only like and subscribe, but leave a comment. All right, anyone who leaves a comment on the video, not only do we really appreciate your feedback, but we do enter you in to win $100 in Bitcoin every single week. So we've been doing this for quite some time, and again, we really appreciate any feedback that we can get. We're always trying to make this channel better for you guys. So I want to talk about a few things, right? I want to talk about current market structure, where we sit within the current trend. I want to get to the title, right? So why do the bulls need the bears, right? The bears are a very important component, all right? As far as price continuing to go north, we need the bears. And that might sound confusing if you don't understand what I mean by that, but hopefully I will have conveyed just what I mean by the end of this video. It's a pretty simple concept, honestly. And then I want to talk about Bitcoin in the global macro picture, right? I want to talk about traditional assets, Bitcoin relative to those. 2020 is a great year so far, but I want to talk about Bitcoin as far as its place on the world stage. It's not a macro asset yet. It definitely is a baby infant macro asset, but it is important to step out of being so isolated within the crypto sphere and to take a larger picture glance at Bitcoin compared to some of these traditional assets, right? We don't want to get too myopic when it comes to cryptocurrency. Okay, there is a global stage, and we do have to keep this in mind. If you think about how, potentially the coronavirus has led to maybe an increase in Bitcoin's price, it's maybe a spurious correlation, but we do need to consider where Bitcoin sits with relation to other assets such as gold, for example, oil, traditional benchmarks, and so forth. So let's get right into it, and hopefully this will be a good video for you guys. All right, guys, so here we have it, and we are looking at the daily chart. On Bitcoin, we're looking at the BitMEX exchange, and some of you might be familiar with the reason why I look at BitMEX, and that reason can change if another exchange leads by volume. But BitMEX is where the most volume takes place, or the most trading takes place. So I want to look at where the most volume takes place for an accurate representation of the market. Now, obviously, this market is going to be somewhat detached. There might be a premium or a discount at times when it moves either further to the upside or to the downside than the spot market. But generally speaking, I want to refer to the exchange where the most volume is transacted. And right now, that is BitMEX, even though in our opinion, and in the opinion of Josh and I, Bybit is the superior derivatives platform, okay? But nevertheless, I'm referring to BitMEX chart more often than not. So a few things that I want to touch on. We gained reacceptance back into a higher time frame range. So what I mean by that is if we're looking at this chart on the weekly, just to label this for you, what I'm talking about is the weekly low and high closes and opens of this prior range that we were within for about a 3-month period. So now going back to the daily, you see that these are the lows. Clearly, moves to the upside were much more violent in the beginning, but we ended up settling in a majority of the time within the lower portion of this. But this, again, from a weekly standpoint, your low and your high on a closing and opening basis. So normally what markets do is they will spend a good amount of time ranging. Okay, they'll spend a majority of the time ranging. They will constantly have this battle at the exteriors of the range where buyers and sellers are in disagreement. So normally we'll see that, if here's fair value, there's the point of control. What happens when price falls below fair value? We'll see that when price falls below, buyers take advantage of this drop in value, bid price up, price auctions higher, same as an auction, right? This is a two-way auction. Price auctions higher, it goes above value. We'll see that sellers will offer this down, and we'll constantly see this pattern occur where both the extremes, the low and the high, are being defended by buyers and by sellers until one side capitulates, or in this case maybe we lose that buying pressure at the bottom and we break down and we gain acceptance outside of the range. So when you gain acceptance outside of a range, that's when you have typically some type of trending behavior followed by, again, price finding another temporary home, consolidating and forming possibly another range. Now, this was a top after a major bullish structure where we had these moves from May or April. And we formed this top, right, where we were stuck within here for about 3 months. So from here to here, you have about, I think it was 89, 92 days, something like that. All right, so this was the range that we were residing in for quite some time. And now we've gained reacceptance back into this range. And this range was quite significant. You can see that when we finally did break down with conviction, we took out all of these clustered stops, had this violent move down, stalled again, and when we moved back up, this was the area that we were rejected from and failed to gain reacceptance back into. And what happens? You fail to gain reacceptance and you begin to seek out, in this case, liquidity lower. So right now, we've gained reacceptance back into this range. So if you're just looking at the lows of the range, again, if we're just looking at something like this, for example, right, just down here at the low, if you're just going to eyeball this, right, so we've gained reacceptance back into these lows, or the low portion of this range. And again, you can see that right here, where my cursor is, this was an area that we were struggling with and we're consolidating against before finally, in a very violent fashion, smashing through. Okay, and we initially came back and retested it. But again, what I want to point out is we're back within this range. So this is an area that I want to see that not only we gain reacceptance back into, but that we maintain. Okay, so ideally you would want to see that if price does push lower, we at least maintain the lows of this structure. All right, to validate the case that we have made a bullish push up, we're back into this range. We're not going to just spend a little bit of time here briefly and then move down lower. So most bullish case scenario would be if we maintain the lows of this prior range that we were within. So right around 9,500, you could say that that's a pretty good area to consider as the lows for any price movement, or rather any position where we currently are with respect to where we currently are. So the area that we actually are interacting with or had trouble with, okay, is the point of control for that prior range. So again, let me just zoom back out. And this area that I have designated right here by this dotted line, this is the point of control for this structure. So again, the point of control is where buyers and sellers were in most agreement. So this is essentially the most fair price based on volume for this range. Okay, so here's your value area low, here's your value area high. This is when it's considered above value, this is when it's considered below value. And the point of control is essentially the most fair value. This is where buyers and sellers came into agreement. This is where you don't want to get into a position because what is your anticipation? If buyers and sellers are agreeing here, why are you selling here? Why are you buying here? Right? Until there's any type of clear break from this area. That's why we take trades at the low portion or at the high portion of ranges, because that's when it can be said that if you've established some type of value area, that any move below is going to be considered below value. You're going to see buyers take advantage of this. Any move above is going to be considered above value. So think about if you drop the price of something that is very valuable. Say we're talking, let's just think about Rolex watches. We had a temporary sale, a one-day sale on Rolexes that are normally priced at, let's say, $20,000. If we drop them down to $10,000 and we only had 100 for sale, how long do you think those would sit on the shelves? They would probably be snatched up right away because that price is below the fair value price. So right now we're back into the area that was considered the low, value area low of this structure. All right. The first area that we were rejected from moving up was the point of control. So this is basically where most of the volume took place. So right now, another thing that's being talked about is whether or not this is a higher high. Okay. Now, if you're looking at this, it looks very clear that it's a higher high, right? We're looking at a daily structure right now. We have multiple daily bars over this previous high, okay, in which we had no closes above right around 95.62. So no closes, but we had wicks. So you'll see that some traders will talk about structure and incorporate wicks. So if you're going by a wick, then we technically have not made a higher high. Now I had a conversation this morning, or a brief comment this morning, because someone was mentioning that we had not broken this wick. And even though this weekly structure is above prior weekly closes, or a prior weekly significant swing point in which we came back into this range and were rejected, we have not surpassed that wick. And one thing that I want to point out is that paying attention to just the wick or just the close, as you'll see sometimes traders will, they'll only be wick traders or only be traders that put lines on closes. It's a very primitive way about going, or rather primitive way to go about the market. So about 40 years ago, I think it's 30 to 40 years ago, the last time this was practiced, volume was only established at the end of the day. So we didn't have any kind of running understanding of what the current volume was for, say, any rotation within a day period. So we couldn't see the volume for a 1 hour candle. We couldn't see the volume for a day before it was completed, okay? So since it wasn't reconciled and you didn't know the volume, you had to go off of certain things such as market structure based on maybe wicks, okay? We didn't have any clear idea of anything besides just where the range was, okay? And volume was, before we could calculate it based on true volume, it was calculated based on how much time we spent in a given area, okay? So it was calculated based on the way that we talk about TPO charts, all right? TPO charts didn't incorporate volume in the way that we incorporate with volume profile. They considered volume to be how long we spent in a given area. So since we don't need to exercise primitive means anymore, since we have access to this information, we could just look at something like a volume profile for individual rotations. So we can see that for these weekly periods where we did have this throwback into the structure, that these highs are pretty insignificant because there was barely any volume that was transacted above the bulk of the volume right here. So we're looking at right around 97.63 as the last area before we pretty much broke off into nothingness, right? Complete vacuum, complete void of volume. All right, minus the, there was probably a couple million contracts transacted above this level, but nothing major, right? Nothing that would even stand out on an intraday or 4-hour chart or something that would be a lower periodicity. So when we're looking at this volume profile on the weekly, we see that we have a lot of volume transacted now at these highs compared to previously. So volume is evidence of buyers and sellers, right? Coming into a temporary agreement, okay? The longer time we spend in a given area, we'd say that there's more of an agreement in that area. But nevertheless, this was an area that was previously unexplored in this high. So I would say that the fact that we're above it now, and we've had quite a significant amount of volume transacted above it, makes it significant enough to refer to as a higher high. Okay, so it wouldn't get hung up on any type of strict definitions. Okay, this is a market. The more access we have to information, the more that we can validate something better. So we don't need to just go off of very primitive things such as candles without support of actual intra-candle volume. So now we know that there's a lot of volume that's transacted over here. I think that more than aptly provides strength for the argument that we've made a higher high. So one of the things that I talk about was we want to look, or what I mentioned in the title was the bulls need the bears. Okay, so let's go down, and you'll see that I have a few areas that, and BlockRoots members, they will know that last night, all right, when we were up here, that I mentioned that these were the areas that we'd be paying attention to. Okay, I have long-term bias when it comes to investment, or rather what I think as far as Bitcoin as an investment. All right, I don't let my trading mix with that. So I take a very intraday sort of day trading approach to the market, and this is likely going to be condition contingent. So if we're in a very fast-paced trending market, I'm going to have a different approach than if we're in a sideways ranging market. But for the most part, I like to play level to level. Okay, I don't like to extrapolate beyond what we have right in front of us, because at that point, I don't want to try to assign probabilities to things that are very far away from where we currently are. I'd rather deal with what is our upper bounds and lower bounds. So again, I trade based on order flow. I pay attention to market profile, and the things that I think are important are areas where buyers and sellers came into agreement, and where they didn't come into agreement, the value extremes, such as value area highs, value area lows. And I take this into consideration with marking up my intraday structures, okay, or the areas I'm going to be paying attention to when I'm going to be taking intraday trades. So we're looking at, this was the week of February 3rd point of control. So this, for this trending week, so this was a trending week if you're looking at it on a market profile structure, but the area where we spent the most amount of time and obviously transacted the most amount of volume was this range within this trending structure. So this was the area that I designated and said we should be paying attention to. And if we continue to progress lower, say we lose this level, I'm going to be looking at the next area of significance. I'm not going to be looking lower until we break what's right in front of us, okay? So I think it's really important to deal with the first adversary you have, right? If you are currently in a fist fight, okay, and you have one guy approaching you faster, and I don't know why this came to a fist fight, but if you have one adversary approaching you well before anyone else, what are you going to do? You're not going to be thinking about the people behind him. You're going to dispose of what is in front of you, all right? take care of what's right in front of your face. I think there's a great speech that's in, of all things, it's in the movie Any Given Sunday, and it talks about the 6 inches in front of your face, okay? Your life is about the 6 inches in front of your face. Deal with what is currently on your plate. And when it comes to market structure, I like to deal with these important areas first, okay? And right now, this important area that we've dealt with was the prior week's point of control, okay? So what I talked about was bulls need bears. So what we need for this trend is we need price to pull back, and for those people to come out that are going to assume that, again, lower prices are in the works, all right? They're going to be betting on a further pullback. They're going to be betting on a massive correction. And how do market participants bet? They place trades, all right? So in this case, in any event, we're talking about needing the bears to short. We need them to short heavily on any break. When we're still maintaining market structure, we want to look for evidence that bulls are really selling heavy, okay? Because what we want to see is that bulls get off sides. So what is a bull getting off, or rather bears get off sides? So just using this line right here because it's kind of clean. A bear off sides looks like this. It looks like an area being heavily sold, broken, and maintained, rather that selling pressure is maintained. So we see, if you're seeing selling on a chart like CVD, so if we're looking at a chart like this, here's your CVD. So this shows you aggressive buyers and sellers, a cumulative delta divergence. What you want to see is something actually like this. See how price action maintains these lows? Okay, it actually begins to drift upward, but you can see the trend is sort of downward with the CVD. So bears are aggressively selling, and getting caught off sides is just a matter of them aggressively selling, like right here, and this is the level. Them aggressively selling, and now price being above the area that they aggressively sold. So now they're trapped below this area. So when I talk on Twitter about identifying trap traders and then leaning on them, what I'm paying attention to is just basic delta. So delta for individual candles. I'm going to be looking at the actual market profile and footprint candles, and we're going to be looking at where they fall within market structure, where some of those aggressive sellers are coming in, where we currently sit. We could look at something like cumulative volume deltas. We could look at rather CVD divergences, which in the case would look like, if we're looking at a line chart right now, in this case, a divergence would be if the CVD continued to go down, all right, meaning this is maintaining, or rather the aggressive selling is continuing, but price action is not. Okay, and then when I say lean on them, I mean that when we identify these trap traders, we get in positions opposite of them. Because when we see that they're underwater, for example, when they're potentially underwater, by leaning on them, we're forcing them to be uncomfortable. Okay, anytime you're looking at the market, when you're looking at where we currently sit, you have to take into consideration where either side is going to be really uncomfortable. Okay, so right now, for anyone who's heavily selling this area, they're going to be really uncomfortable the further up we go. Okay, and some traders who are shorting this area might use this as a stop, right? So the further we get towards this, okay, or the more we progress up towards maybe a most recent microstructural high, the more we could anticipate we might force shorts out of position. And ultimately what we're looking for, and why we say we need the bears, is because we need them to jump off sides. We need them to be off sides so that when we do force them out of position, that cumulative selling, or rather that cumulative pressure, that buying pressure that comes from shorts closing out, causes prices to spring upward. I don't know why I got tongue-tied right there, but I certainly did. So that's what I want to pay attention to. Okay, I'm paying attention to these key areas. I'm going to be looking at the delta in these key areas and seeing, again, how we come into them. Are we seeing that they're aggressively sold? So if we're looking at my Sierra chart right now, I'll be looking at these areas and paying attention to something like this chart right here. So we're going to be looking at, in this case, it's going to be showing you the volume profile. It's going to be showing you the dominant side. So in this case, you can see, for example, we have red right here. That means there's negative delta. That means that in this case, we had more traders hitting the bid, aggressively selling, than we did have traders lifting the offer. So now if we have a ton of this volume down here, so let's say in this case we had something like this. Okay, so see this candle right here? This is actually a volume profile, but it's of a 4-hour candle. You can see how this one with this one over here, there was a majority of selling. Okay, negative delta throughout the entire candle, a lot of volume transacted. Now as soon as price moves up and away from this area, anyone who aggressively sold this, and you have to make sure that with open interest, these were positions to open and not to close. So this was not aggressive selling from longs closing out. Okay, we want to make sure that this was to open, so shorts to open. Now when we see this, when we're above it, we could assume that these are being pressured. Okay, we want to lean on these types of or we want to lean on these types of conditions when we see the market is in this type of condition where we have traders that are potentially offsides. So that's what I mean when I say that the bulls need the bears. We need to see that we need pay attention to if for example you want to just look at Twitter right now, you'll see that Twitter has suddenly went from being overly bearish, and this is an extreme, so this is why paying attention to Twitter can be harmful. But you could just see how quickly the sentiment flips, all right? And if you begin to think that if someone is overly bearish, do you think that they're opening up a bullish position or a bearish position? Once you start seeing that areas are being aggressively sold, maybe you pay attention to something like CVD divergences, futures discount, okay, funding. So if we're starting to sell and you see that, for example, funding goes negative, all right, so where longs are being paid to open up positions, shorts are paying, okay, because in that case, the aggressive short is the dominant position. All right, or futures discount, where the futures temporarily trade under the spot price, again indicating that that same selling is not occurring on spot markets, but it's occurring with large notional positions with high leverage on the derivatives platform. Again, these are types of things you could pay attention to identify that maybe bears are getting caught off sides or setting up to be caught off sides. So that's what I meant by we need the bears, right? We absolutely need the bears, and the bears need the bulls, right? The bears need the bulls to get as euphoric as possible, all right, because they want to capture them offsides too. So now let's talk about the macro picture, because this is something that I wanted to mention. You know, we're pay attention to the news. Everything that pops up is with respect to the coronavirus. Okay, it's turning out to apparently be a pretty serious issue. You see a lot of things immediately get referred to the flu or to more common ailments that we have. But this is the first time that we're really dealing with something in a very connected society where you have things like Twitter, you have multiple sources of information, you have the concept of fake news. But nevertheless, we'll see the markets will respond to these things, okay, before everything is kind of reconciled and we find out just exactly what the extent of the truth was. So December 31st, all right, marked the beginning of the timeline. And what we want to do is pay attention to traditional assets during these major things that have major market, rather global market implications. So what you'll see is that there will be, in this case, there's a strengthening of gold. Okay, we saw a temporary sell-off. We saw a big sell-off in oil. All right, we saw a correction. I wouldn't say it's a correction, but we saw temporary pullback in the S&P. But again, we just went on to make all-time highs again because that's all the S&P 500 does. But I want to pay attention to Bitcoin and where it sits with relation to these assets. It's always good to keep this in mind. Bitcoin has been the number one performing asset, I believe, of the last 10 years when you're even talking about something like Dow Jones, or you talk about any type of traditional benchmarks. Pretty much every asset that I could think of, minus a few that might have been one-offs, major gains that went on to just crash back down to nothing, sort of like biopharmaceutical stocks and so forth. But right now we see uncertainty over the coronavirus. Okay, so the dollar, gold, Bitcoin up. You would think that the dollar, if the dollar is really strong, we might see that our exports suffer from that. Okay, but the dollar is up because you have to imagine that there are people that are seeking out safe havens. They're seeking out U.S. Treasuries, and the dollar in this case is going to gain from this flee to quality, rather this flee to any type of haven asset. So ultimately, what we want to see is that Bitcoin does what gold does similarly in this regard. It becomes a store of value, becomes a haven, sort of that asset that everyone flees to in the event of any type of doomsday scenario, which in the case of Bitcoin might not actually be the most beneficial when you think about how it might actually be something that's more tangible like gold. But nevertheless, we saw gold appreciate, we saw the dollar appreciate. So I just want to put on some of these charts right now to give you an idea of where we sit in 2020. So we're looking at Bitcoin, looking at the S&P, the Dow. Let's look at the dollar. Okay, dollar currency index. Okay, and then let's look at oil. So CL. Oil took quite a hit. I think it's around 49 right now. It's down, I think, 22% for the year. Thinking about anything else, Dow Jones, Bitcoin, gold we have to put on here. So in this case, gold futures. All right, so let's go back to 2020. Okay, beginning of 2020, just to give you an idea of where we sit. Now, normally, all right, when the dollar is weakening, you'll see that there'll be an inverse relationship. As far as recent history, an inverse relationship between the dollar and gold. So when the dollar is declining, you'll see an increase in gold. Again, this should be kind of clear what gold represents, what gold has represented in traditional portfolios. But as far as this year, okay, Bitcoin is in a very clear lead. Okay, it's up 36% for the year. All right, and then if I just put the labels on to make this a little bit clear, because it's not exactly the colors I would have chosen. All right, we have the S&P 500 up almost 4%, gold up almost 4%, just behind the S&P 500. Dow Jones 30 up 2.5%. Okay, and then the dollar up almost 2%, and then crude oil almost down 20% for the year. And this is a pretty useful way of looking at, rather comparing assets. What you can do is you could go onto TradingView, you go into compare, and all you can do is just type in any kind of symbol. If you put onto compare, it's going to immediately put it into percentage terms. So you're going to be able to see, based on where you anchor this access to, how each asset is performing relative to the other. Okay, so we could go to the beginning of this week. All right, let's go back to the 3rd. All right, last week, we could see just how we've been performing since the beginning, or the week of the 3rd. Okay, Bitcoin up 5%, S&P up 4%. In this case, crude oil almost down, though just over 3.5%. But right now, what we see is that there is sort of this self-fulfilling nature, this self-fulfilling prophecy that's occurring with Bitcoin, I think. That even though some of these correlations might be spurious, all right, in the long run, it might be spurious to consider that, Bitcoin is necessarily going up with, if we go back to December 31st, or first week of January is probably the best week to go back to. First week, midweek January, as far as when coronavirus really had an effect on the markets. The correlation might seem spurious to begin with, but we have to imagine that through the aggregate, or the total amount of people acting on the idea that there's an actual haven in gold, rather a haven benefit in Bitcoin, by them continuously acting on the presumption that Bitcoin is going to fulfill that goal, or rather fulfill that purpose, we will see more and more people shifting their attention to Bitcoin. Okay, and from a risk-adjusted return standpoint, from a Sharpe ratio standpoint, there's really nothing that beats Bitcoin in this regard, in the fact that it has potential nonlinear growth ahead of it. Okay, and you could basically just allocate a small portion of risk in any well-balanced portfolio and still benefit heavily from any type of, again, small allocation in Bitcoin. All right, and this will probably open up as more and more cryptocurrencies gain traction and actually have some fundamental use case behind them. Again, we'll likely see some type of Pareto distribution. But keep this in mind, okay? A lot of people mention how the correlation between Bitcoin and some of these macro events, whether or not we're paying attention to a Fed announcement, whether or not we're paying attention to Brexit, okay, or coronavirus, all right, there are meaningful, all right, correlations, or there are meaningful interactions between these types of events and traditional large macro investments, or rather macro assets, in that you'll see an immediate response, okay, based on high frequency traders, hedge funds, all right, things that spin up instantaneously. You'll see this on a tick chart. Whenever something releases, these assets will move immediately. All right, there is a slight lag with Bitcoin, but more and more we're starting to see this window, all right, this period of lag begin to shorten, okay? And as far as Bitcoin goes, it has no fundamentals, all right? There are no fundamentals. The only thing it has going for it are its technicals. So people attribute value to higher prices. So if Bitcoin can maintain above 10,000, we'll likely see it gain more mainstream attention again. And this all really helps progress the potential appreciation that we're all trying to take advantage of, okay? In this case, large scale adoption and massive appreciation, okay? Because again, it's a low float asset, it's highly reflexive, and it does have this concept of halving, which is going to have a direct effect its supply, okay? So hopefully this has been quite clear. Sorry for all the okays and all rights. We know how I talk. But if anyone has any questions, absolutely feel free to reach out. This is Ryan, aka Kenner and Clark with BlockRoots. As always, exercise proper risk management and trade effectively.